Hey everybody, it's Thursday evening, and you know what that means. It's time for the Financial Thing weekly YouTube live stream where we chat about all things investing. Tonight we are very peer-to-peer focused, and we have a special guest with us. I'm going to introduce him in a minute. First of all, have to do the disclaimer, which I have a nifty little pop-up now. I usually read it, so here it is, the disclaimer that this video is awesome, but it's for informational purposes only. The content of this video is not financial advice and has been prepared without taking your objectives, financial situation, or needs into account. You should consider its appropriateness for your circumstances. All investing carries risks, and opinions expressed in this video review are opinions based on my own personal experiences and of the opinion of our guest. And the FSCS does not cover peer-to-peer lending or most other investments, and your capital is at risk. So please don't invest more than you can afford to lose. Very important. Remember to diversify. So this evening we have a very special guest. We have Michael Bristow. He is the founder, one of the founders of Crowdproperty, which is a company that we've talked about a lot on the stream, who is becoming more favorable within the peer-to-peer lending space, doing a good job from what we can see so far. We're going to be chatting with him. If you have questions for Michael or comments, pop them in the chat, and I'll go ahead at the end when we've done chatting with Michael. We'll throw some of these questions at him and see what he has to say. So let's go ahead and bring him. There he is. How are you doing tonight, Michael?
Very good, Lawrence. Great to be here. Good to see you.
Glad to see you too. Thank you for spending the time, and we really appreciate that. Let's go through, chat a little bit about what's going on at Crowdproperty right now, and we'll go from there. Yeah.
Sure.
Sound good.
Definitely.
Okay, perfect. So, just really fast, what year did you launch Crowdproperty? Because I can't remember. I know we've talked about this before.
Yeah. So we've been around for a bit. So we founded the business in 2013 and started lending in 2014.
Okay, so you're almost six years now, almost coming up on 7, huh?
Yeah. Almost exactly 7, in fact, from when we founded the business.
Yeah,
Yes.
that's pretty cool. Amazing how time flies. So,
Indeed.
Mike, give me a little bit of background on what you used to do before you launched Crowdproperty, because I think it's important that we find out who the people are behind these companies. It's becoming essential now. So tell everybody what it is that you did before.
Yeah, totally agree with you. So I left university many years ago. I did a master's in mechanical engineering, so a very quant-heavy degree. I'm a numbers guy. I went into management consultancy, specifically in the strategy space, advising major corporates on corporate strategy and private equity houses on M&A buyouts, and also the strategy of their portfolio businesses. I did a MBA at London Business School, which was an incredible experience, and a brilliant international network. I think in our class, actually, of 75, we had 25 different nationalities. It's such a global school. I'd been investing in property alongside my management consultancy career since 2002. So I've been investing in property myself for 18 years. And on so many different levels, and different purchasing, different refurbs, different developments, so many different tenanting structures, etc. And I have just a deep passion for property. And in about sort of when probably similar time to founding Crowdproperty, I developed a sense that technology would have a far greater role to play in what is the world's largest asset class. And so I started investing in prop tech startup businesses, probably before prop and tech had actually been coined and put together in a way. And fast forward that a little bit, and it's it's a really hot sector at the moment. And the only thing that I have outside of Crowdproperty and running Crowdproperty, because my absolute passion, my joy, my commitment is I actually sit on the investment committee of Europe's most active prop tech venture capital fund, which actually has really powerful benefits to stay right at the cutting edge of technology and what it can do, because it has so many, prop tech has so many overlaps with fintech, both of which are very, very applicable into what we're doing at Crowdproperty in terms of disrupting that property finance space. And that pretty much takes us to here. Yeah, we've been on a great journey, and we've got a team of 32, and we look at this in a way we have a fundamental belief in doing peer-to-peer lending exceptionally, and that's our commitment to the space. And there's very importantly two elements to that, which we might touch on a bit later. That is, it's not about doing peer-to-peer lending exceptionally. It's about being the best on the borrower side and being the best on the lender side, because that is how you grow a great business in this space.
Yeah, absolutely. And one of the things that we talk about, Mike, in the stream, every week when we're here on a Thursday, is the importance of finding the right companies to invest in. Especially now, we've had some failed companies, and the director and founder experience is becoming just equally more important now than almost the loans that are being written. And I know you'd mentioned to me before we hopped on the stream here that your partner, Andrew Hall, is a RICS 35-year RICS valuation man, 35 years experience. So tell me what you said about him before we hopped on live here.
Yeah, so the three co-founders are myself, Andrew, and Simon, and I'm picking up with Andrew first. Andrew, as you say, 35 years qualified RICS surveyor. He has personally built millions of square foot of property in both commercial and residential. He's worked throughout the sort of real estate value chain in all different aspects of it. And so he has enormous credential, but also attitudinally, it's very important as well. He's grumpy, right? And I often say that to him. He's grumpy, and he doesn't like approving loans to fund. And that is a fundamentally good starting point for a lending business. We, as a lender, have the right fundamental mantra, which is you're only a lender if you get the money back. Otherwise, you're sort of a charity without a cause. And guess what? Property developers aren't Britain's favourite charity. So that's the fundamental here. It's brilliant lending, and probably to typify that, Andrew's one of obviously one of the approvers, but one of the leading expert in the team that ultimately validates deals that then go to investment committee. It's very hard to get a loan through Andrew, number one. But number two, our team have processed £3.8 billion worth of applications. And as of today, we've funded 98.6 million and we'll be going through 100 million next week. That's less than 3% conversion rate. That's around about what it should be. It's our reference set. Our reference data set is so powerful, and we are very, very comfortable with that level of conversion. And it does mean that we've, I guess that one criticism of the business really at the moment is the speed that things fund, and there's a lot of capital looking for projects. But we will never relax our criteria. We've only ever tightened them over the years of operating, and no matter how much property experience and development experience, i.e. exactly in the asset class that we actually have, we still learn through the process of 7 years of running this business and get better and better and better. And so sure enough, we only ever tighten our criteria. And that provides a good deal flow. but it's we are not influenced in the volume of projects that we put onto our platform by the availability of capital, and that is a fundamental responsibility of companies in this sector, I feel.
Yeah, absolutely. And I definitely want to sort of talk to you about what's going on with the sector within peer-to-peer lending. I know for anybody that's not really familiar with what you do, because there will be some people, if not this evening, that do watch us in the future, just give me a very quick rundown. If an investor comes and invests money through Crowdproperty, what is it exactly that they're investing into?
Right. So I'm actually going to, and bear with me on this. I'm going to talk about just briefly the reason why we exist.
Okay.
And the reason why we exist is, so there's myself with deep property experience. There's Andrew with exceptional, double my length of property experience, and Simon, who he's 25 years investing and developing. Mm-hmm. And we said back in 2013 that raising funds for property projects, small residential property projects, was incredibly challenging. And the funding products in market were not fit for purpose on many different levels. So we said, well, let's build the best small and medium-sized property professional business lender for their property projects. And the numbers are quite stark here. So we all know that the indicators of capital not flowing to SMEs in the general business sector, but that's very relevant in this sector as well. So in 2008, small builders contributed 30% of housing supply in the UK. Okay, actually, one of the things that the UK is very, very good at doing or spectacularly good at doing is the consistency of building 200,000 homes a year. The problem is we need 300,000 homes a year. But in 2008, of that 200,000, 30% were built by small builders. By 2017, only 10% were built by small builders. And if you go out, and we did last year, as we do always, and we had our market intuition anyway from ourselves. Is this just a declining market, or is there a major barrier and issues to it? The good questions that a good strategy consultant would ask. And we went out, we did a survey of 500 SME builders last year, and the and 41% said we need better sources of funding, by far the biggest factor. And that validates exactly what we set out to do. Briefly, what is it exactly that we lend against? So we're doing small property projects that could be anything from a light refurb through to a new build project. Mm-hmm. And that is those projects are in all throughout the UK at mainstream price points. Our average pounds per square foot is 298, which is right in the heartland of mainstream demand in the UK. In liquid markets, and where the supply that we are funding is immaterial to the overall demand. And on those principles, you wrap around a load of criteria that have tightened over time. We always put first charge security against it, which is the critical thing. And it's actually something that's underestimated. There are platforms out there that do a mix of first charge and second charge, which you've got to look out for, because first charge not only gets paid back first, but also has control of recovery. Mm-hmm. And it's actually control of recovery that protects that first payback best. Right. And that's an often underestimated benefit of that first charge security. Mm-hmm. And we vet those damn hard. Through a lot of experience in exactly that asset class, having been there ourselves, doing exactly what they're doing. And that's, ultimately what we've put around this is first charge security, market-leading expertise in exactly this asset class, a very, very rigorous due diligence process, and that over 6 years of lending, 7 years of business operation is what's fundamentally behind 100% capital and interest payback track record. And that's, we pride ourselves on that. And we're very, very prudent, very cautious, and really tough on our lending. But ultimately, and I come back to this point where you've got to be the best you can possibly be on either side of your marketplace, not the marketplace as a whole. Ultimately, we went out there to build the best lender in the market based on our intimate knowledge of what's needed and what's wanted, okay, so that we can attract the best projects and fund the best projects. Because our service to the borrower is not just about the money. It's also about direct relationships, expertise-based relationships, value add through the process, and a partnership that gives the maximum likelihood of success of that project.
Right. That's what we want. Now, you have one of our readers actually put in a comment yesterday on Facebook, and he was a little bit confused because he was asking me about the minimum. What's the minimum pledge on a manual lending?
So on a manual, it's 500,
okay.
£500.
So his name is Peter, and he told me that inside of your current terms and conditions, there's a line, and I don't know if this is a mistake or if it's something that was old, but it says in section 3.3, it says there's no minimum or maximum pledge amount. So he was wondering if that had changed since the terms had been written.
No, that was always the case. Actually, it's always been £500. And however, that changes in our auto invest world, which is what that will partly reference as well, because effectively what you get is auto invest is fascinating. Because when we set out to build it, we had a clear vision of it. And actually, the algorithmic complexity for what we've built and the various elements to it is amazing. And we're very proud of that. And we can talk a bit more about that, because we find that a lot of people are really interested in the dynamics between auto invest and self-select, especially under rapid funding speed.
Mm-hmm. Yeah, that's definitely one of the things that I get emailed about the most, and some of the readers wanted me to ask you about that. And I know the last time I had met you in London, you said that your mother was a little pissed off at you because she was having trouble getting her manual investment allocations. So talk to me a little bit about what's going on with people that have bigger account balances that are trying to get some kind of a diversification into Crowdproperty are really having some issues, and that's obviously a demand and supply problem that you're having to face in the balance of keeping things that way. What are you going to do to make this a more fair or even thing for people that are trying to manually invest with bigger accounts?
So first and foremost, it won't be relaxing our criteria, put it that way. This is something I've quite openly said, that we don't want projects funding in 24 seconds. We want to drive projects funding into 24 hours, so that people and their availability does not constrain their ability to get into projects on a self-select basis. Mm-hmm. And that requires us, that's origination. We're getting £200 million worth of applications a month. Okay, and what we work hard at are two levers on that. Number one, increasing that overall volume, and number two, increasing the quality mix such that it will pass our criteria and ultimately get funded. And we're working constantly very, very hard at that. And actually, we have a unique origination system that is. That we go direct. We've built a direct to developer brands rather than effectively buying market share through brokers. Mm-hmm. And that's immensely powerful on a number of fronts. And I might come back to that if we have time. But let's focus on exactly that question. So when we put something out, I'm going to start. So our insight a few years ago on the dynamics of our lenders, and through both activity but also research, was that firstly, some people wanted to actively look at projects and choose projects and say, I like that one, I don't like that one. And they would have their own set of assessment guidelines or gut feel or whatever that was. It was always obviously underpinned by our due diligence and our filtering of 97% plus out. And then there's the dynamics of people that say, look, you as a business critique this very, very well. I would like to maximize my diversification and put something into everything. And they're two very strongly segmenting dynamics of activity. So that's the insight that said, right, build auto invest. And where we are now is, and you're right, my mother's one of our biggest critics. When loans were first going very, very fast, I think she would typically be the first caller in on my mobile to the office saying, "Oi, I didn't get into that one." but I mean, we do take this very, very seriously, and so for example, since lockdown began, end of March 23rd in the UK, we funded over 60 projects. And the average funding time for those projects has been 52 seconds.
That's fast.
And it's fast. We don't want that. Again, I'd rather 24 hours each. But there's a misconception in the market that says, right, you allocated all to auto invest. And what we do roughly, it's about half we allocate to auto invest. Okay, and we balance that based on the demand. And then a half is available to self-select. And the self-select people, I mean, I didn't know that people could type this fast. I mean, we funded during lockdown 2 projects in 12 seconds.
Yeah.
And half of those were people typing in pledges. Obviously information is available before so that people can do their due diligence. That's really important here. I must emphasize that. Mm-hmm. So it is, we give a very fair chance for self-selectors to participate, it's a problem that we take seriously. Now, some would argue it's a good problem to have as a platform, mm-hmm. Okay, and I accept that, but we don't treat it as a good problem to have. We treat it as a problem, and we're working hard to bring more supply in, as I mentioned. We have in the past tried various things, and we've implemented pledge limits, for example. So for the first 5 minutes, you have a maximum self-select pledge of £5,000, for example. And that's where we might implement that for certain size of projects or certain periods of time, just to moderate that and enable not only existing investors but also new investors to get in.
Yeah.
But nobody gets a differential treatment both within auto invest and within self-select. There's no queuing. There's no nothing. It is purely list open. Auto invest allocation, self-select people acting quickly.
So this might be a silly question, but if you're having loans filling in 12 seconds, would a solution not be to reduce the size of the pledge amounts to give everybody a fair opportunity to get invested manually into those loans?
Well, I mean, pledge limits effectively does that in a way. So that will limit the total pledge size. So we often set that at either £5,000 or £2,000 maximum pledge.
Okay. Yeah, I was wondering maybe if you were to be able to reduce that down a little bit further, would that remove some of that annoyance by some of the investors that probably piss off the people that have huge accounts and then.
But that's the problem. Yeah. It's a bit like government policy in anything, right? There's intended consequences and there's unintended consequences, and arguably you might treat the pledge size limits as a percent of their investable capital or something like that. You could devise so many different complex ways of doing this, and for simplicity of especially of communication, we've done it on a monetary amount, and that does frustrate some of our larger investors, and we don't particularly want to frustrate our larger investors. So it's a balancing act, and we analyze the hell out of this, and again we've probably proportionately got a large team for our level of funding, a large team of 32, and a lot of analytical resource. And I'm a numbers guy, as I said earlier, right? We delve into absolutely everything, and our tech platform and data and analytics is incredible. And we're looking at all this all the time to try and just make the best and fairest decisions throughout our process. That's for the good of everyone, right? Especially one of the fundamental principles, which is achieving diversification.
Right. That's insanely important for anybody that's sort of new into peer-to-peer lending. Diversification is the key. You don't want to put all of your money into any single one loan, especially, or a single business. I say, try to spread that money around, but be very careful where you put your money nowadays. And also if you have comments or questions for Michael, go ahead and put them in the chat. We're going to get to them when we've gone through our questions. There's about 42 people watching you live now. Michael, which don't start sweating because I see you're in a suit. That's why I wear a t-shirt. I get nervous on these streams, and if I had a suit jacket on, I'd just be drenched. I'd be drenched in sweat.
I'm just wearing more clothes than you because I'm in London and you're in Orlando.
Yeah, because it's so cold. That makes sense. Michael, what are the rates that lenders can expect to get currently, and do you see any change in that, or do you think it's going to remain constant?
So between 7% and 8% is our contract rate that we offer. Interestingly, if you take a look at our overall book, and I can do a rundown of stats for you in a bit, but just zooming into the sort of let's think about the risk and reward balance because that's really important. So over the lifetime of our platform, our average lender return is 8.74%, and 100% capital and interest payback track record, and which isn't an indicator of future performance. Caveat, important FCA guidelines. And so why is that larger than the contract rate? Well, there's partly historical because. When we actually started out in life, we were offering 10%, and actually that's a really interesting debate as well, because what our average contract rate has come down slightly over time. Okay, and by decimal points of percentage. Okay, but what we are transparent about, okay, and this is really, really important. Okay, we fundamentally believe in transparency. We've got an award-winning statistics page that, again, I just like data. But what we're very transparent about is what the borrower pays and what the lender gets. Okay, this sector is fundamentally about more efficiently matching the supply and demand of capital. Okay, and what we have on average, so it's on our statistics page, on average our overall borrower contract rate, so the developer contract rate is 9.74%. Okay, and our average lender contract rate is 7.92%. So broadly 2 percentage points different. Okay, and understanding this is fundamentally important, because let's simplify those numbers, right? It's 10% to the borrower, 8% to the lender. Okay, and we can operate as a platform with that spread.
Mm-hmm.
That is an indicator of risk profile, because if you're a lender and you're saying I'm getting 8% and I don't know what the borrower is paying, then there's a huge difference of risk profile if the borrower is paying 10% or if the borrower is paying 12, 13, or 14%, because that's the grade, the risk assessment in an efficient market of what that debt should be paying. And our 10 and 8 gives lenders a very healthy proportion of what the borrower pays. Mm-hmm. If that number was 13 or 14 and they're getting 8, that's a less compelling proposition. I'm getting less of a fair share of what the borrower is paying. So this differential, if I was to leave one tip for the audience, is understand that the average borrower rate, the average lender rate, because that is the secret to understanding what the real risk is associated with that loan, that platform, etc.
Yeah, and that's something that the FCA has implemented as being mandatory for companies now to display what that spread is. And I'm noticing that some companies are still actually not putting that information on their website. So it's pretty interesting.
Vast majority.
Yeah. Why do you think that is?
I mean, it's not because they don't have the data, right?
Yes. You're afraid to be transparent, perhaps?
We have a transparent attitude, and we believe that that information is important to make good investment decisions.
Mm-hmm. Yeah, absolutely. I'm a big proponent of having that spread be extremely transparent, where people can really see it, because a lot of investors are not particularly experienced, and some people get into peer-to-peer lending without knowing really what they're getting into, and some of those stats are not particularly easy to find. So I do like the fact, I was just scrolling through your stats page, Michael, and I popped it up on the screen. So if people want to go look at that, it is very easy to find. It's crowdproperty.com/statistics. Do you don't have a secondary market, right? That's one thing I remember about Crowdproperty when I was doing my investing.
That's correct. And we've debated this a lot internally, and we've also asked our lenders. We do a lot of research, and actually, secondary market is very low down what our lenders request from us. But I think there are some bigger picture issues here, and I think that secondary markets will come under a lot of scrutiny from the regulator over the next year or two. The sheer existence of a secondary market does not mean that you can sell your loan parts.
Yeah, we've seen that, especially now.
Exactly. It does. You've got to have a buyer for your sell side. So that's sort of first and foremost. The other things, I mean, particularly about Crowdproperty, our average loan length is around about 14 months. And again, in our research, both focus groups and also quantitative research, that is a good time horizon for investment, and people generally recognise that. Not everyone, but majority do, and they like that. But there are other aspects to a secondary market. If you apply the principle of, stock exchanges, for example, there is potential for information asymmetry and potential for people to trade on information that is superior to others. Okay, so I'll give you an example in property development. There's someone lives near a site, and they suddenly see no activity on that site. And they're now a seller, and then there's a buyer out there without that information. So it can happen in business lending as well, right? The car park of the business could be less busy, whatever it is. But there are a lot of dynamics here, and then there's pricing, and what the principle and the behind the pricing should be, and then there's an understanding of really is it an efficient market or not. So many dynamics that will put this, I think, under scrutiny going forwards, and is part of the reason, part of the reason that we don't believe that having a secondary market on Crowdproperty is right at the moment.
Okay, understood. Thank you for the explanation. We're just going to answer a couple of questions here. We'll sort of give this a midway break, and I know some people have put some things in the comments. So I'll pop the question up on the screen. I'll just read it out for you, Mike, since you won't be able to see this. A lot of people are saying hi. Somebody wanted to know if you are related to Eric Bristow.
No, but okay. My cousin, when he was at university, he got the nickname Crafty Cockney, which was Eric Bristow's dart nickname. Okay, and given he's my cousin, that would theoretically make Eric Bristow my father, but he wasn't. So anyway, yeah.
That's pretty funny. Yeah, I had to put that one up there. I thought it was, I'm sure you get that a lot, right? With that last name being tied to a famous darts player. For anybody that does, some of the younger people may not even know who that is, but even I remember him.
So he sadly passed away recently. Yeah.
Oh, did he? I didn't even know that. Oh, rest in peace, Mr. B. We have a comment from Norman who says, why is it so hard to find how to move money around inside the Crowdproperty account? It would be helpful to have a move money button with the various combinations as options to select.
Yeah, so there's a couple of things here, and we definitely understand this feedback because we obviously research and also listen through various forums and channels. So we're working on that definitely. I mean, one example is that in order to take money out of your ISA, you need to move it into your standard account and then move it out. We are working on the UX firstly of our site, and that's quite a big piece of work. And secondly, the actual functionality of where you move money and take money out of, etc. So we're definitely aware of it. We are working on it. Bear with us, and we'll bring you something shiny and easier shortly.
Okay, that's good news. Norman P also says that we approve of Grumpy. So talking about Andrew Hall, so you've got a thumbs up.
Yeah.
You got a thumbs up from that.
It's a good lending trait. Yes.
One of the other watchers wanted to know if you only take 3%, where do the other 97% go to?
Well, look, I mean, it's actually this. It is part of our relationship building with borrowers, and we go through their project in great detail. We've got brilliant tech, brilliant analytics, etc. But the way we see that is the tech is for efficiency, especially around data analytics, etc. And then it's actually the expertise that drives our effectiveness that take on the outputs from that tech and the analytics. And we go back to them and say, well, look, this project has issues on these fronts. You may have thought of some of them, but look, fundamentally this may not stack, or it's not good enough for our grade, or whatever. And we actually go back to borrowers quite often and say, look, are you sure this is the right project for you? You found one. You can find another, and you should make sure they factor in sufficient reward for their time and effort into doing a development. Development projects are hard, right? They're hard to lend against. They're hard to assess.
Right.
They're hard to deliver, and they take a lot of time and effort. So not only do we as a lender want to see sufficient skin in the game, firstly, in terms of developer equity, but also sufficient profit margin and cover on our loan and the value of that loan, the capital plus the interest by the end of the project. But we also want to see those developers make some profit and sufficient profit for their time and effort, because that drives that motivation.
Right.
So we will have, we have direct dialogue. This is not a computer says no business. We'll give feedback, and that drives deeper relationships with borrowers who come back, and they come back. And we've had people we've rejected 7 or 8 times, and then they've found a brilliant project. They're out there. They're tenacious. They're entrepreneurial. They're good enough to deliver a project. They just haven't found the right one yet.
Right.
And that I'm actually just going to touch on one other element as well. And actually, data and analytics and economics and spreadsheets and things like that, that's easy, right? We like data. What you really need to understand, okay, is the human. So a great project can be stuffed up by the human that's involved, right? And
really, I'd never heard that before. Yes, of course, yeah.
And look, so we, because we directly originate, we have that direct relationship. We're speaking to them 20, 30, 40 times before writing a loan, and we're really understanding under the skin of ambition in property, motivation in that project, and commitment to overall, when, okay, and I'll highlight when something goes wrong, because in property development, stuff goes wrong. There's no project where nothing goes wrong.
Yeah.
Okay, when stuff goes wrong, okay, does that person have the ability, the motivation, the ambition to always dig deep and deliver? And it's that richness that we think gives a real edge, especially around our direct origination.
Okay, that's good. Let's see here. We got a question from Paddy Gilfillan. I want to say that's a good Irish name. Hopefully you have this information, but if not, tell us what you know. He said, I share your enthusiasm for property. It's where I invest myself. How have you dealt with tenants or borrowers who have defaulted? That's the first part of the question. And second part is, what's your loan to value on both domestic and commercials? I'm presuming domestic would mean residential.
Yeah, so great. So I'll do the numbers bit first. Yeah. That's not just because of my number preference. We look at 3 metrics. Okay. Number 1, initial loan to value. Okay. So I'm going to give you an example of the project, and say, for example, you buy something for £100,000, you spend £100,000, and it's worth £300,000. Okay, that initial purchase will fund, so £100,000. The initial loan to value is how much we release on day one against that security. Mm-hmm. Okay, and the average across our book is 59.7%.
Okay.
And naturally, in 2020, we've been tighter than that because we've tightened our criteria, understandably. And that is 55.9% for the 2020 cohort. We then look at loan to GDV, including interest, which is the capital cover, and excluding interest, which is the capital cover, and including interest, which is the overall loan coming back. Okay, so what is owed at the end against the 300,000 on that theoretical project? So excluding interest, our average is 53.6% on across the entire book. So that's the capital cover, and then including interest, 58.5%. Mm-hmm. And in 2020 cohort, that's 56.6%. And again, that's all on our statistics page. And shown for every loan. So we they are criteria that clearly drive a lot of our underwriting, and actually the power in that is not the statistic at the end. It's are the assumptions going into it correct? And that's where we, as property experts ourselves, we really understand that and can validate that very carefully.
Okay.
First bit of the question was, sorry, I've forgotten. I got carried away with numbers.
That's okay. Yeah, just real quick, because time is kind of running out. I don't want to keep you on here for too long. We've got a lot of questions, but it was, if you could just give us the quick process of what happens during a default recovery. How do you handle something like that?
Yeah. So again, this is a very, very careful balance between action, recovery action, formal recovery action, and the enabling the incumbent developer and contractor on site to continue with the development of the project, because that causes least disruption. Okay. Mm-hmm. So it's constantly with those two elements in balance. We've had 6 loans that have ever gone 180 days late. We've recovered 4 of those, 100% capital and interest. The other 2 we are about to close out in full recovery. Mm-hmm. Okay, and 4 of those have gone through full legal repossession process. And so when it comes to it, we know how to handle that, and we get the perfect result.
Okay, good answer. Steven says, "Hi, Michael. Thanks for your time. I've been an investor for about a year now at Crowdproperty. Just wondering if you think the lower Bank of England rates will affect your rates in the future and the future of your loan book."
So, lender rates, as I mentioned earlier, will be driven by borrower rates. Okay, so we don't move lender rates in a way that's different to the way we move borrower rates. We lockstep that. Mm-hmm. Okay. The only place or rationale why lender rates will start to come down is if the market is competitive on the borrower side and starts to factor in those interest rate declines, and we have to sharpen our pencil on that borrower side to ensure that we close the projects we want to fund because they are the best projects. And again, that's where the interrelationship between borrower rate and lender rate is so fundamentally important. Mm-hmm. And so the answer is, I don't know perfectly. We work hard to bring the best rates, as I've explained to lenders, and we are competing in an active market for great projects to fund.
Yeah, understood. Scott Peacock, hi, welcome to the stream, Scott. He says, what's the default loss rate in the last 12 months for Crowdproperty?
0.
That was an easy one.
Yeah. I mean, again, we've paid back. To be exact, we've paid back £48.4 million so far from our 98 million cumulative lending. Mm-hmm. And we're actually strangely, we're fully expecting to go through the 50 million paid back landmark the same week as the 100 million lent landmark. It's just an oddity, and in no way by design, because we've got a couple of big paybacks coming. But we've paid back 14 million since lockdown began, and that's a tough exit market, right? It's a tough refinance and tough sales market,
right?
But we've managed that really actively, and been right on the exit models, the exit routes for our developers, and we've got 100% capital and interest payback track record.
That's a great one right there. That was probably the easiest one you've had to answer tonight. Yeah. I gave you a layup.
I managed to turn an answer that should have been just 0 to 4 minutes of rant.
That's okay. You're very passionate about your business.
Yeah.
Mike, so let's talk about in a minute. I'm going to get to the big milestone that you've hit with your £100 million lent. But first of all, I just want to talk about trust. One of the things that us investors have at the moment is, if we've been invested through the companies that have fallen, And obviously, we're going to experience some losses. We got the Lendy funding secure collateral situation, possibly some other ones, Wellesley. What do you tell people now as investors? Like, how are they going to trust companies like Crowdproperty giving you guys another shot if they haven't invested through you before, and maybe they've taken some losses in these peer-to-peer companies? How do they trust that, to dip their toe again without getting burned?
I think, look, I can comment on that from the way we go about our business. And we go about our business by building a 10, 20, 30 year plus lending business. Okay. And you build that through quality lending. And actually, as a business, we're 7 years old, lending for 6 years. And you could argue we're only at 100 million. Okay, and we spent a load of that time building the right platform, the right process, the right experience, and the data, etc., and turning a lot away. So really understanding from platforms, what's their funding conversion rate is a great stat. Are you getting a fair slice of the pie? So you're aware of the sort of market tested risk rate that you're lending against. And transparency. That there have been a lot of examples, a number of examples in the market where either growth has been chased. If we had an attitude of chasing growth, we wouldn't be having. We wouldn't be in a situation where loans are funding in seconds, right? Because we're just very cautious about the lending side, and the other thing is, which I think is really important, okay, is we're a business that's always said we're going to resource ahead of growth, ahead of demand. We are a very well-resourced business, and one of the ways we can do that is because we're not based in London. Actually, we don't have a London fixed cost base. We're in Birmingham. We've got 32 people in our team, and a lot of those people we recruited, have been around well over a year. And this time last year, we were probably a very, very similar size. But again, we were really investing in developing that team. Okay, and everything is in house, and we have a culture of passion that really sits behind the fundamentals of funding good housing projects. Okay, that deliver housing into the market, spend in the economy, and delivering a great product to that. So we haven't chased growth. We're here for the long run, and doing this properly. This is partly. I mean, I drive people crazy, right? Because partly will have been nature, but over 18 years as a strategy consultant, all I look is the long term. Okay, and make sure that all the fundamentals are in place that make sure that it's a brilliant long-term business. Okay, and that goes down to at the micro level, making sure everything is perfect. And that's how we think, that's how we operate, and we resource our team really well. And so look, in any market as it matures, there are going to be people that maybe don't have the right experience or outlook or strategy or business model or whatever it is. But these are the things fundamentally, we've spent so much time debating and getting right in our business.
Okay. All right. One word answer. Okay. Ready, Michael?
That's very difficult for me.
This is easy. What's your favorite tea brand? Did I get you on that one?
Yeah, I drink coffee. Lapsang tea. It's a type of tea, but yeah.
Okay. And what's your favorite? Who do you support in the football world?
Tottenham Hotspur, who are spectacularly good at throwing away leads at the moment.
Okay. I had to break that up for you for throwing a little curveball.
Yeah.
Because we talk about... one other question, okay? One word answer. Trump or Biden?
Or?
That's it. Trump or Biden. Who do you pick?
I mean, it's I can't call that at the moment because I don't think Biden is that stellar actually. We'll see in the debate tonight, right?
Yeah, hopefully he can stay awake. All right.
Yeah.
Trump or Boris Johnson?
Actually, definitely Boris. I think he surrounds himself by some very intelligent people.
Okay. Good answer.
And I think that's important.
You'd have to say that. Imagine if you picked Trump.
Yes, exactly. Yeah.
That was a good one. Okay, so let's talk about Crowdproperty's big milestone and what that means to you. I know that's something you're very proud of. The £100 million lent.
Yeah, so we should go through it next week. Again, it's property, so deals move around. But it is a big landmark, and actually, and it resonates a bit with what I've said already. Is that's just an output, and I'm actually proud of the time it's taken as well, because I truly believe that we've spent the time and we've resourced the team to build a brilliant product that has real scalable potential, but scalable potential with a quality level that is at the heart of it. And part of that is culturally innate now in our business, in terms of risk management, prudency, quality, excellence, and all of these sort of factors that demonstrate that not only what I say as a founder, as a CEO, but also what our newest recruit who joined 2 weeks ago might say. They have a passion for this business, our cause, and we've also delivered a really stable, robust business that is profitable, that gives them stability and job security. And if you take that concern out of it, then and all of their emotional intelligence is put behind the passion and the mission, it's incredible. We've got a lovely office in Birmingham that is pounds per square foot is a hell of a lot cheaper than a lot of other places. But it has a conference room that's glass, okay, so people can see who's in it. There's not another wall in the office because it's a single culture. All of our team is there. For example, our tech developers, our tech team is about a third of the business. They're not only in the business, but they're in the office. It's not outsourced or in another country or whatever. And that's important for to really align themselves fundamentally with the ethos and culture of our business. So it's an output metric, right? But just very briefly, so 100 million is 230 loans against 170 projects from 3.8 billion pounds of applications, as I said. It will be 50 million paid back next week. 100% track record. We funded 1,100 homes being built, worth 195 million pounds, and our lending has funded 80 million pounds of real spend in the UK economy on labour, materials, and services, and the way we've operated and the principles behind our brand and the reliability that we've proven, as I said, it's 60 plus projects since lockdown, and they've been funded exceptionally quickly in a really tough market. But we've been able to deliver a product that has secured yield to it, and we are delivering every day and passionately. And look, it's we're building a very long-term business, and we love customers on both sides of our marketplace, and want to be a partner for life for both sides of that marketplace.
Yes, and as investors, we want you to be around for a long time. A couple more questions for you, Mike. Dave Dawson says, are you comfortably solvent? I'm pretty sure he's asking about Crowdproperty and not you personally. Yes. Are you talk about the profitability of how one of the things that impressed me about Crowdproperty when I first met you, Mike, was you said you've been profitable for a while. So yeah, Dave wants to know how you comfortably solvent.
Yes. So we've been profitable since 2019. We've been profitable every month since lockdown. And look, we manage our business very carefully. The great example there is I think that if our business and our team were based in central London, our costs in that business would be at least twice as big. Okay, and that would mean either one of two things. Number one, we wouldn't be able to resource it as effectively, or number two, we would be less robust and resilient as a business. Mm-hmm. Okay, and those two things are really important in this sector. And so everything we do, we really think about that. And it's not extravagantly profitable, right? Because as I've discussed, we give the lion's share of the returns or what the borrower pays to our lenders, and that's what we're about. So look, we are a very robust and resilient, sustainable business, and some of the elements to the business, okay, is because sort of stability of the business is not just about here and now, okay, because if you were a commodity or whatever, then in a month's time, someone could undercut you and take market away from you. We've built a strategically differentiated business model, and one of the most powerful examples of that is our direct origination, and that brings so many different benefits to not only the economics of the business, but also in terms of the richness of our underwriting, the richness of our monitoring, and ultimately getting the right result, which is the money and the interest coming back.
Okay. Dave, also, I know you've already answered this. I think you said it was 14 months, but he wanted to know your length of loans. Is that the average? You said 14 months?
Yeah, average 14 months. It gets, so we will lend between 6 and 24 months is our spread, but average overall is 13, 14 months.
Okay. We already answered this. There currently is not a secondary market, Dave. But that's something we've discussed if you want to watch the stream. Let's see. Dave also asks, do you have a monthly interest option that's paid monthly?
So how to answer this quickly? No, not an option to the lenders, but some of our projects, our loans are serviced, and therefore you can get a monthly payout on some of those projects. Typically, and the way development finance really works is you sort of think about the borrower's cash flow, right? Mm-hmm. The borrower's cash flow is they need money at the start, they get money selling it or refinancing at the end. So that's when you get the capital and interest back. That's the majority of our loans.
Okay. Tony Walton has a bit of a gripe. He says that his main gripe is the delay on the starting of some projects with funding locked in and no returns. What can be done about that?
The delay of projects starting themselves.
Or probably starting late. Is your loan system to where if you put money in, you start to get paid from the moment you invest in the loan, or is it when the project begins?
Got it.
Yeah.
Got it. Right. Okay. So the way our system works is we list the loan when it's sort of 98% through the completion process. So it had the vast majority of legals, etc., done, and so people pledge at that point, and then we will call funds, and our average completion time between funding on the platform and actually starting the project is about 9 days, I think. And there's a spread around that, so there is a little bit of cash drag on that, and we recognize that. That is unfortunately the reality of property as well,
right?
Because you need to do that formal completion process, especially if it's our projects will have exchanged in purchase, but there's also always a completion process. There's a money flow process, getting ready for that, collecting the funds, etc. But what that enables is actually, and I think this is important for auto invest as well. In auto invest, people have the option to skip the next project. Okay, and we felt that was an important option. That was one of our focus groups raised that. If someone hasn't got on in time to skip the project, they have a cooling off period of 24 hours to be able to retract that pledge, and we might top it up on the platform. So that sort of gap also enables things like that as well. But we get that. It is a nature of the sector as well.
Yep, absolutely. It's understandable. Another thing that has been mentioned in the chat too, Mike, is about loans that run over the time that they're supposed to be redeemed. This is obviously a reader's comment. So Farah says 82.2% of the loans on Crowdproperty that I've lent my money to haven't redeemed when Crowdproperty stated they would, or even within 3 months of the target date. Obviously, we can't really verify that, but how do you handle loans that do run over time? Because obviously with property development, that's something that is absolutely going to happen. Property developments do run over. How do you handle those situations to keep them, in a good timeline?
So I'm guessing that 82 odd percent is therefore, so 17%, 1 out of 6, so 5 out of 6 not running late in that case. So property developments can run late. We only have 2 at the moment that are over 180 days out of 170. 230 loans in total. What we do is, and again, this is all about the triggers and the decision making about any recovery process and any formal recovery process. So we have very, very tight governance structures in place for review. Anything that's going late, we'll know 3 to 6 months ahead, typically, if we think something's going to go late, because we can track that against expected timelines. First and foremost, we try to back, because it is, in the vast majority of cases, the best outcome, about the developer, about the contractor on site. Secondly, we work really hard to understand what the issues are, and we try and help that, because we've got a good open relationship with our borrowers. Thirdly, we recognize it's an inconvenience. Okay, and so therefore, and I don't know many platforms that do this. If a loan has run late, that's an inconvenience to you, and you should get something for that. So, say for example, a loan that was 8%, that would go to 10% in the period that it is late. And our feedback generally is that is fair compensation for that, and actually often appreciated, right? Because there's no underutilization cash drag, and people are on 10%. But I mean, all seriousness. Okay, we're all over that project and those projects, and ensuring that they get recovered. The last time I did this analysis, our analyst did the analysis, is that our average payback was 6 days early, right? What I haven't done the analysis of how many projects, what percentage have actually paid back on the day that has been expected. These are projects, they're complex. Some will finish early, some will finish late. Okay, right. But we make sure it's a fair outcome and a fair position in any of those circumstances.
Okay.
And sorry, just finally,
yes, go ahead.
And we make damn sure that there is very good security cover on that.
Most important. Radislav Kafov asks, "Hi Michael, good evening. Why is it that your borrowers can't find more attractive rates than the 10% you offer them?" So a good question here. Why do they come to Crowdproperty versus going maybe to a high street bank or somewhere where they can get lower lending rates? Is it convenience, time?
So the market for SME development finance is where we're at. Mm-hmm. Okay, we need to be on point in the market to attract great projects. And that is where the market is at. Now, you're absolutely right. If you go and get your project funded by Lloyds Bank, you might get it at 6% or 6.25%. But these are, property development has significant risk about it. So there is significant risk premium over the risk-free rate. But to get funds from Lloyds, you probably need to be, working on a project that's 10, 15, 20 million in size, delivering a lot of units into the market and have 30 years experience. Mm-hmm. Now, that's not exactly true. I don't know the exact criteria. But look, traditional sources of funding, as I started at the beginning of this conversation, traditional sources of funding failed property developers and small and medium-sized property developers. And we need to be on point on our pricing to attract good projects. Okay, so actually the final point here is one of the pains in the marketplace is that we did a brilliant piece of analysis versus a competitor the other day, and what the outcome there was that the headline interest rate was lower than ours. But when you factored in the fees, the hidden fees, and all of the what-if fees, which is rife in this industry, okay, actually we delivered a cheaper product, a better product to the market. So again, that transparency not only fits on the lender side, it also fits on the borrower side as well, in that we do not have all of those fees, because that builds stronger relationships over time. So you're exactly right. The economic principles here is we want to win good business, and we need to be on point in our pricing. So we attract great applications by price and close it through service and expertise.
Good answer. That was good. Let's see, a few more questions, and then we're going to run really quick through the other topics of discussion that I know I put on my list for you. Are you okay hanging out for a little bit longer?
Yes.
Okay.
Yeah.
I know you're passionate.
It's my favorite topic, right?
You love talking about your business. So. Okay. Let's see here. So, let's see. Alan Toombs asks, he apologizes for being late, first of all. I don't know how long ago this was written. It could have been an hour ago. But he said, is there an easy way of seeing the current state of each investment on the site that takes account of repayments? Not sure I fully understand that question. Does that make sense to you? So
this is probably, I'm guessing you're getting into one of the nuances of property development. That, say, for example, there's a development that's 10 units, and partway through they've sold 2 units, and they're paying off some of the debts, which always brings down or increases the security cover, brings down the LTV, which we always insist on. It's an important part of that partial payback piece. So on an individual loan basis, that is, we think we firstly need a little bit of work to just sort of click in and drill into individual projects. Probably the best way to get to that is is we make sure that you can both download your loan book, but also your transactions, which is always reference pointed. So if you're a spreadsheet geek like me, then it's sort of it's you can get into it that way. Again, I'd have to ask some of our lender relations teams on exactly that drill down. I don't have that to hand, but you can always get there on the raw data that is very easy to download into Excel if you like that kind of thing.
Yeah. Okay. I think he was also talking about how partial repayments were handled.
Yes, it's that partial payment piece, so it's the 10 flats being built, 2 sold. So, and always the critical thing to managing this from the underwriting and risk side in our business is always that that money comes back to us to pay down the risk exposure through the process. So partial repayments are a good thing on risk management.
Okay. Let's see, Mike. So Lloyd Lobo has asked, and I'm sure this isn't the first time you've heard this. How do you compare your lending model to Property Crowd? Because I know your names are very similar, and sometimes people get a little bit confused. Now, as I understand, Property Crowd is no longer operating in the retail space, so I would imagine there's not much similarity with what you do, anyways.
Yeah, we've never tracked them.
Okay.
We track some players, but we've never tracked them.
Easy answer.
So, yeah.
Let's see. Patty says, do you factor in an FSV for each property loan?
FSV?
Yeah, I don't really know what that is. Patty, maybe you could elaborate, because I'm not sure what FSV is. FSV?
It's not a term that we use. I wonder if there's a synonym for that. No, but if he could clarify, I'll definitely dig into that.
Okay. Let's see. Have you had actually any properties that have gone all the way through into a default scenario, and how have those played out for you?
Yeah, so we've taken 3 through full legal repossession process and fully recovered everything.
100%.
So yeah, capital and interest. And it's really important. This is where stats like 59.7% overall initial LTV and 58.5 loan to GDV, including interest. That's why you need some of this cover, right? Because that recovery process takes some time, and you need that headroom to allow interest for accruing in that, and B, if there is some kind of exit that requires quicker selling or a certain like investor mindset selling or whatever, then that cover is vital. Understanding those statistics again is vital.
Yeah. Tony says, we've already covered this, so I'll answer for you. Is Property Crowd profitable? If not, when? Yes, they've been profitable since 2019, Tony, and they continue to be a profitable business. John Day says, modular homes seem to be coming. Would Crowdproperty be happy to fund these?
Yes, and we do. We have a dedicated modern methods of construction product which funds exactly these type of projects. I mean, for example, a pretty cool project we funded was an airspace development. So I mean, it was literally a crane dropping a modular built flat on top of a freehold building near Waterloo Station. It's quite a cool project. Now, if that was a joint venture with the freeholder, as a third-party freeholder, then that would have been a holy trinity of property deals that involved airspace development, modular development, and a joint venture. And this is some of the stuff that's so vitally important. The 3 of us have 75 years investing in development experience. We understand all of these deal structures and can put things in place. But in particular on modular is difficult. It's the UK is well behind the rest of the world in terms of modular modular housing. But one of the complexities is it has different cash flow requirements, and some of that cash flow you've got to be really careful about securing, because it's effectively work in progress in a factory.
Mm-hmm.
So actually you've got to think about things in so many different ways, and we've built bespoke structures for many of the projects that we funded around that. But we really get it, really understand it, and again that resonates in the market.
Okay. A couple of nice comments that people are saying about Crowdproperty and yourself, Michael, that you seem to be a very sincere gentleman. So that's a nice thing. I know you can't read these. So, and Norman says that he wishes that all peer-to-peers were like this.
Thank you.
One other question that I got from the Facebook group. By the way, if you haven't joined the Facebook group out there, if you're not on it, get in the Facebook group, because it's a place where you can come and ask questions like this for the stream in advance and learn everything about lending. But Mike, somebody, and I can't remember who this was, who wrote this, apologies, but he said that you're very successful with no defaults to date. You must have excellent due diligence and ongoing project management, which we've already talked about. We know you do. He was saying, can this continue in the current situation with what's going on with COVID, and what actions can you continue to take to keep up this good record? Yeah, how has COVID affected your business, and can you really keep this stellar track record going through COVID?
I mean, first and foremost, at some point, that may be compromised, right? It can only go one way. That's not going to be anytime soon. And so through COVID, you're absolutely right. That's been a major disruption in many markets. Okay, now, first and foremost, building and construction was encouraged to continue by Robert Jenrick, the housing minister, as long as those sites could be operated safely. And that's where the secret is, okay? Because it's well publicized was the huge tower blocks being built in Battersea, and how do 300 people have lunch together, under COVID-19 lockdown. Well, that had to be shut down, right? In terms of those kind of sites. But our sites, the vast majority, 95+% by value, is outside of London, less dense sites, smaller sites, okay, that you can implement safe operating procedures on and continue. Maybe with a few fewer staff, okay, but you can continue. And our book did. And we worked really closely with all of our borrowers, not only in terms of how you're doing and what are your challenges. Okay, and we were hearing some brilliant stories about people being very resourceful in getting materials and different things that they found constraints on supplies onto their site. But also we were picking up all of these challenges, all of these solutions, all of the perspectives that we had as people that have been on building sites and built things and learnings, and shared those with all of our borrowers.
Right.
And a load of them were like, oh, that's a brilliant idea, where we described how do you do, non-human interaction, supplies delivery sign-offs, and, right into the detail, right? And this is fundamentally why deep asset class expertise is just so important.
Mm-hmm. Yeah, you do have some. Oh, by the way, Mike, I found out what FSV stands for. We both learned something tonight. Fire sale value. Fire sale.
Right. Okay. So
yeah, Patty said, do you factor in fire sale value for each property loan?
So typically that's the 90-day valuation. On a RIC survey. So yes, absolutely. And actually one loan we were considering today at investment committee, we were talking about 90-day valuation and the cover on that. So yes, absolutely. We look at fire sale value. We look at break-even unit sales, break-even pounds per square foot. So many different views at looking at risk management of each and every project. Yeah, very much so, because that is one of the covers that we've got to think about.
Okay. Good answer. Alan says he already liked crowd property, but he likes it even more now that he sees how passionate you are about the business that you're developing. So, that's one thing. I'm very picky about who I bring on the streams. Obviously, I'm an investor with crowd property myself, albeit a small one at this time. But I like the business fundamentals ever since we got together in London and had that chat. But by the way, if you haven't seen that, and you want to watch the interview that I did with Michael in London. I think it was January 2019, if I'm remembering correctly.
Yeah. It's a good time ago. That was that place called Central London.
That people used to frequent.
It's not very busy.
Yeah, but if you want to watch
anymore,
that, it's a 3-part interview that's on the Financial Thing channel, so you can go ahead and watch that. See if I had. Yeah, how has I know you said that a lot of people are actually working back in the office now for crowd property up in Birmingham. Have you seen that COVID has really impacted the amount of applications that's come through, for property development at the moment?
So yes. So it's really interesting looking at the market, because what basically happened is in development finance market, okay, loads of lenders stopped lending. Now, why did they stop lending? Largely because they have single sources of wholesale capital, and often those single sources have other parts of their businesses that are typically linked to equities that were exposed to volatility in the market. So those kind of businesses say, right, let's just go on pause. Right, and that choked off a lot of the development lending in the market. We have institutions and lots of people lending through our platform, including my mother, as you know, Lawrence. And what we were able to do was lend through that, okay, but to tighter criteria, to projects that could proceed and get going, and it was appropriate to fund at that time. Mm-hmm. What that's meant is that step changed our reputation in the market. And whereas before we were sort of 150, 160 million of applications per month, we're well north of 200 million applications per month now. We will unfortunately reject a lot of those for those borrowers, not unfortunately, but for the lenders, absolutely right decision. So that's been a major sort of factor of COVID-19 for our business, and actually has been a very strong opportunity because of the work we put in to build a great track record and a trusted brand. We had that liquidity in the market, and that will has step changed our market positioning for going forward. Now, your other point there is, yes, we've been back in the office in Birmingham for the last 2.5 months, and like many businesses, we were very productive and very communicative during lockdown. But one of the things that were burning in the back of my mind was, are we as innovative and disruptive as we were when we were all back in the office and firing ideas around? It's very difficult to schedule a brainstorming session on Zoom. It's not quite as natural as passing conversations, ideas, and testing, and chipping into other people's conversations, etc. Part of the reason why we have a fully open plan office. And so we take it very seriously. Our office, we have a rotation policy around the teams. About half of the team are in at any one point. I'm up there Monday to Wednesday. All of us take private transport into the office. It's another benefit of not being in central London and being reliant on the tube. But that innovation is back, and I'm hugely excited about that. And it really has proven to me. It's proven to me that the office is not dead as a very, very general perspective for human beings.
Right. Yeah. Mike, peer-to-peer lending has taken a really beating over the head over the last 2019 to 2020 with these failed companies. What are your views of the whole industry? We know that you love crowd property, obviously. What are your views, though, as the industry as a whole? Where do you think it's going to go? Do you see a contraction to continue within the industry? Do you think it's going to grow?
I think there will be a contraction of participants, definitely. It's a natural sort of evolution of a sector, right? There's the nascent early stages where there's a lot of people coming in, and then there are the good operators that start to shine, and then the people who haven't been able to make it work, make the economics work, make the stability work, operate in a good way that drives long-term differentiation and success. That they naturally fall away, and now a big stimulus for that will have been is obviously COVID-19, and that will accentuate that drop off that will be very different to the evolution of of many other markets. Also, I certainly am hearing in the market that the FCA are bearing teeth, which we think is a great thing, and we've seen that by a number of decisions around authorization and supervision, etc. And look, the sector is fundamentally brilliant in what it is. Okay, more efficiently matching the supply and demand of capital, right? Enabling that pound in my mother's pocket, okay, to go more efficiently to someone who will use it, add value to it, and reward my mother as a result. Okay, and so it's fundamentally better economics, structural cost advantage versus traditional sources of lending, and that endures. So there will always be a sector here, and the cream will rise to the top, and that's a good thing, because the real danger in this sector, is that this is a sector that deals with people's money, and that is why it's horrible seeing failures, bad operating practices, insufficient resourcing, etc. But the fundamentals are there, that for the good operators delivering a brilliant service to customers on both sides of the marketplace, it will exist and thrive.
Okay. We're going to come to an end soon. A couple more questions, and then I'll get you out of here. I promise, Mike. You've done a great job tonight. Thanks for spending so much time with us.
It's a pleasure.
John Day says, do you expect loan flow to reduce over the next 6 months, or the 3% acceptance rate to also reduce?
I mean, the second bit is not necessarily. There's a proportion of quality that, and we're actually going to try and, we work hard to drive up volume and drive up quality mix through the campaigns of origination. So hopefully that increases, but it will only increase if we find better stuff. Will loan applications reduce? I think the overall market may come down a bit. Okay. But as I described, we've step changed our reputation in the market, and we are attracting more and more applications on a month by month basis. So we are taking a greater market share of applications, and we will therefore be taking a greater market share of funding in this market. I truly believe that this 100 million is the first 100 million of many, and we've got a strong future ahead, and that's going to fund a lot of house building in this country, and we can do with that economic spend right now.
Yeah, absolutely.
Oh, sorry, and the final bit on that is actually there is a slight question mark about whether the market overall will shrink, because there's a lot of government impetus right now about enabling and unlocking some of the barriers behind house building. Actually, when you ask the market, the four biggest things that the SME developers want to unlock the market are: number 4 is taxation benefits. Tick, government working on that. Number 3, planning legislation relaxing. Okay, tick, the government are working on that lever. Okay, it's just so happened, and then the next one is improving economy. Well, we've all got to work hard for that, but they are small compared to SME developers asking for better sources of funding, which is exactly what we're delivering. And so that and what we can bring on that will help drive the market up.
Okay. Thanks for that, Mike. I don't want to. This one's going to be like, make this one real quick because I know this one could really be an in-depth question. But Patty wants to know what's your rejection criteria on loan applications, not in detail, just sort of a roundabout way how you decide if something makes it through or not. If it gets by the grumpy Alan Hall, how does it get by?
Hall, it's tough. It's tough, right? So look, there's all the metrics and the analytics we do. So there's about the project, loan to value, loan to GDV, etc. Then and how liquid is the market, how profitable is the project? All of these elements, okay, and all of which are incredibly important. But it's also an assessment of that individual, as I mentioned earlier, which is subjective, not objective. And that is one of the key bits that upholds our track record, because we place huge importance on that as well as the relatively easy bits around the numbers.
Yeah, good fundamentals. Okay, I'm going to ask you to go out on a limb here. Okay, you could say no if you don't want to answer this, but Gary Thomas has asked, who would you class as your competitors? And I would add to that, who do you think is doing a good job in the industry right now?
So, as I mentioned earlier, we compete in development finance, okay, on the borrower side. I don't, whether that's alternative finance players, peer-to-peer lenders, or not, or traditional sources, that whole set is the set that's competing for good development projects. And I just on SME house building says that the market's been underserved. Financial services is not famed for its customer centricity, especially on property side, and that's why we set the business up. So I'm going to do the really annoying thing, right, and say, seriously, we do look at other players and large players in the market, and we make sure we serve our property professionals best, because that's what attracts them, retains them, and brings them to market. So I've dodged the question entirely.
You gave me a completely political answer there.
Yeah.
Michael. I understand, but I mean, is there anybody in the peer-to-peer world that you respect and say, hey, I think that these guys have done a good job too to help support the whole peer-to-peer sector in general? Or
so we used to be part of the Peer-to-Peer Finance Association when that existed, and then we evolved that into the Innovate Finance 36H group. We're a founder member of that with Funding Circle, Zopa, Lending Works, and RateSetter. And the heads, so the CEOs sit on that board with Charlotte Croswell, CEO of Innovate Finance, who is brilliant, by the way. And the leaders of those businesses are brilliant minds, working very, very hard, and we share a lot of good practice, best practice between us, and so I hugely respect the CEOs of all those businesses, and I think that experience they have as a collective group, we have as a collective group, does benefit the development of each of our businesses, and benefit the development of the sector, the solidity of the sector, and the operating standards of the sector.
Good. That was a great answer. I like that.
Thank you.
Okay, so you wouldn't have seen this midway through our stream. Michael was answering a question. I had to hop off the seat and run downstairs because I told Michael, I was like, keep talking, and I apologize for that, Michael. I wasn't trying to be rude. But I wanted to just mention this because you talk about companies servicing their customers, right? So I've got about a 4-year-old MacBook Pro, and I don't know, about 4 days ago, I opened this thing up and it didn't work. The computer was on, but the screen was completely black. I called up Apple and I said, hey, this is what I have going on. And they said to me, you know what? We're going to send you an overnight box, put the MacBook Pro in the box, ship it to us, and we're going to repair it for you. No problem, no cost. I think I sent it 3 days ago. The FedEx man came to the door while I was talking to you, dropped the computer off, and that was why I had to run downstairs. But the point being, for people who are always talking about, companies that are run well, like you seem to be a very well-run company in the peer-to-peer lending space. Apple is doing an amazing job servicing their customers on that end, being able to take a 4-year-old computer, say, you know what, we're going to fix this thing for free, and we're going to do it within 3 days. You talk about exemplary customer service. If you can, serve your customers in that way, they're going to keep coming back to you, paying for, God knows how much an Apple laptop costs these days, but I know they're very expensive, and that's why my loyalty lies with these companies that do right by me, and yeah.
And the fundamental there is, delight the customer where it matters. Okay, so the research, they didn't accidentally serve you well there. That they understood that from their customer base, that actually when something goes wrong, if you can sort it out quickly, that's important, and that buys long-term loyalty, because they're building a long-term business. And I've worked in so many different and on the acquisitions of so many different consumer businesses, and it's actually amazing. I've seen so many private equity funds and partners of private equity funds, who are brilliant numbers people, okay, and brilliant financial brains, just poring over the consumer research, okay, and using that insight, often just the words, to make decisions around acquiring businesses, because that's so important. What the customer says is so important, and we absolutely hold that core in our business.
Yeah, that's great. Well, Johnny, one of my friends here, says that this is what makes people come back to businesses, that they build such a great long-term relationship with their customers. So I hope that you'll continue to do that. Mike, we've taken up a heck of a lot of your time. Is there anything else that you want to say to the people out there who are watching still? And thank you for everybody's been so patient. We've had about 41 people all the way through this long chat, and I could keep talking to you for hours, because I find what you do really fascinating, but obviously it has to come to an end, and we'll definitely have you back on. Yeah. Is there anything else that you want to say to the YouTube world out there?
I guess it's really important to understand under the skin of these businesses, the statistics around, the transparency around the way they go about the business, the way they think, and the individuals involved. And thank you for a great set of questions and a chance to sort of introduce me a bit further in the way we think and the sort of principles behind our business. It's always great being sort of face to face, even though we're getting very used to two-dimensional face to face in this world, but it adds a lot of richness to what everyone's about. Yeah,
so. Absolutely. If you want to give Crowdproperty a try, I put the link in the comments down below. I personally do invest, and I should also say that I'm a shareholder in Apple. Somebody wrote that in there and said I should declare that I am a shareholder in Apple. Been for a while, but yes, thank you again, Michael. Check out Crowdproperty. It's a good company. I think they're doing good things. You're actually on my list of companies that I think are doing the right thing by us investors at the moment, so I'm sure you'll continue to do that. And we'll definitely, would you come back on with us in future and talk about what you're doing in the future? Love to have you back.
Definitely. And I'm very happy to have a Q&A session at any time. Always, hey, it's my favorite topic.
Wonderful. So. Okay, and everybody out on the stream, don't forget that next week there will not be a stream. I'm actually going on my holidays taking a week off. So we'll be back on November the 5th. We have David Bradley Ward from Able Rate joining us on November the 5th. So we'll see you then, and hope everybody has a good week. And remember, as my teacup says, live, laugh, and love. Be healthy, be safe out there, and we'll see you next time. Thanks again, Michael, for being a good sport. We'll talk to you soon, okay?
Cheers.
Okay, bye.